everyone, you're welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Ayodeji Ebo, an investment professional. This week, we will be reviewing the implication of the increase in interest rates on savings accounts. In general, the CBN reduces rates to stimulate the economy and raises rates to control inflation. Recall that the CBN had driven interest rates lower during the COVID-19 pandemic to boost the economy by encouraging spending by households and businesses. Last week, the CBN announced an upward review of the minimum interest rate on savings accounts to 30% of the monetary policy rate, the MPR. Coming from the previous low of 10% of MPR, this takes the minimum savings interest rates to 4.2% per annum from 1.4% per annum. The savings deposit rate is the interest rate that accrues to customers for keeping their money with the banks. Why is this relevant? In simple terms, consumers are more attracted to saving when interest rates are high rather than spending and vice versa. The MPC has already raised the MPR, its benchmark rate, twice this year by 1% and 1.5% in July and May respectively. The chances are that it would increase rates again to keep fighting stubbornly high inflation, which reached a 17-year high of 19.64% in July 2022. Now, what are the implications of higher savings rates? 1. Better returns for savers. In general, higher interest rates are good for savers, as it implies that you will see a higher return on your savings. For instance, if you leave 1 million in your savings account for 1 year, the return will now be 42,000 naira compared to 14,000 naira in the past. This return will triple. Notwithstanding, with inflation still above the return on your investments, any money locked in savings loses purchasing power over time. Rather than lock your funds in a savings account below the rate of inflation, the best thing to do is to invest in high-yielding fixed income investments like commercial papers, placements, and federal government savings bonds to enhance the buying power of your investments. 2. Rise in borrowing costs. In response to the recent savings rate hike, the interest rate on loans for businesses and consumers will also increase, leading to higher finance costs and ultimately higher cost of goods and services. For instance, the pricing of commercial paper rates has been benchmarked to the interest rate on the bank deposits rather than treasury bills rates. This creates a ripple effect on the economy as businesses and households will cut back on spending on goods and services, which will then slow the productivity of the economy and the economy's growth. In addition, existing loans with adjustable rates may be repriced upwards given the higher cost of funds. This will also increase the borrowing costs for the government, leading to the rise of debt servicing. 3. Increase in banks' cost of funds. Savings deposits are generally essential to banks' business model as they are used as a low-cost funding source. An increase in savings rates will drive up the interest expense cost of funds of banks, meaning that they will have to pay more on the interest on savings accounts. In addition, interest rates on placements will also rise, leading to higher interest expense for the banks and potentially lower profitability. The impact will be reduced with the expected rise in interest income on loans. 4. Mild impact on inflation. The goal of an interest rate hike is to get the inflation under control by reducing incentives for businesses and consumers to spend. However, inflation in Nigeria remains largely driven by the supply side cost push pressures, such as the infrastructural deficiencies, the heightened insecurity in food producing states, the high cost of inputs alongside other factors. 5. Sell-off in the stock market. When interest rates rise, it becomes more expensive for companies to raise capital or service their existing debts, which could lead to a downward revision of profit expectations of companies, and at the same time, it could curb future growth prospects. Investors tend to price this into the stocks of their companies, thereby leading to a lower price of the company's stock. Also, from a dividend yield view, the stock market becomes less attractive relative to the fixed income market, leading to sell-offs. However, equities still presents great opportunities for long-term players. 6. Rise in fixed income rates. The increase in savings rates will transmit to higher interest rates for fixed income instruments such as commercial paper, federal government bonds, treasury bills, and so on, due to the recent reference to interest rates on bank deposits. Institutional investors / fund managers prefer to place funds with the banks at the prevailing high interest rates rather than lock in funds in fixed income instruments due to the ability to withdraw funds when needed. This is positive for investors as this means a higher return on investments to reduce the impact of the rising inflation rates. Thank you for listening. Please join us same time next week for another exciting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 070-8246-3747. Stay blessed.